Welcome to this episode of the Common Sense Skeptic, breaking down the Tesla Q1 2024 call from April 23, 2024, where the biggest surprise of the call was the effect that it had on the stock price. The trading day leading up to the release of the presentation deck at closing was lackluster, rising and falling throughout the day, settling at a small gain of 263. But at the closing bell, the stock began to spike, and by the time the call and after-hours trading wrapped up, the share price had shot up significantly, almost $20 per share. Which means people weren't paying attention to or didn't understand what they were listening to during the conversation nor reading in the printed materials. Nothing presented in either format justified a $20 jump in stock price. So that will be the goal of this breakdown, to take a look at what they overlooked. And because we've had loads of extra time to produce the episode, we're able to add a lot more context to the breakdown and the subsequent fallout, because there is a lot happening at Tesla right now. All is not as it appears. For fun, we're going to be playing along with the bingo card provided by Bloomberg to see which notorious Musk catchphrases found their way into the prepared statements and the Q&A that followed. But before we go into the call, let's go through the presentation deck that was distributed 90 minutes before the call started, while also referring to this visualization graphic provided by appeconomyinsights.com. Starting off with the highlight summary page, noting a profitability of $1.2 billion GAAP operating income and $1.1 billion net income in Q1 is represented on the graph right here in green, both of them indicating a company-wide profit margin of just 5%. Under cash, despite stating an operating cash flow of $200 million in Q1, they had a negative free cash flow of $2.5 billion in operating expenses represented here on the graphic, and $1 billion of that was assigned to the AI infrastructure Capex, or capital expenditure. This dropped their declared cash and investments by $2.2 billion. Under operations, the 3 points being made are the increase in AI training compute by 130%, record energy storage deployment to 4.1 gigawatt hours, which Tesla's battery suppliers have to be very happy with, and the fact that the Texas Gigafactory produced 1,000 Cybertrucks in a single week in April, which is more than a quarter of the total number of Cybertrucks that were recalled recently for a potentially deadly issue with their accelerator pedal. The summary starts off with the numerous challenges that the company decided to pawn their declining sales off to, including the Red Sea conflict and the arson attack at Gigafactory Berlin. Berlin? Okay, that was probably a legit problem. But the Red Sea issue? Guess we'll find out later what the problem was there that only seemed to affect Tesla. They also claim a decline in the COGS, or cost of goods sold, but clarify that was primarily due to lower raw material costs, as opposed to any improved efficiency in the factory. The pressure on EV sales globally is mentioned, with some companies deciding now that hybrids are actually the better way to go, which of course goes against the all-electric mantra at Tesla. We had actually suggested some time ago that the new model Musk was teasing at the time should be a hybrid, so that the company could take advantage of that growing market sector, but hey, what do we know? Wrapping up the summary, the deck discusses cost-cutting measures with the final paragraph reiterating the price reductions for their supervised FSD product, which, despite Musk's claim going back in history, was supposed to appreciate in value over time. The price has dropped from a high of $15,000 down to $8,000, and now is also available as a subscription service for $99 a month. 4 years ago, to justify a $1,000 hike in the software cost, Musk had actually assigned a value of $100,000 to this same package that he's now flogging off at $8,000. The following page gives the sales breakdowns across all categories, and they weren't good. Total automotive revenues down 13% year over year, the lowest number of the previous 4 quarters. Energy generation and storage, were up 7% year over year, and the nondescript services and other revenue, presumably things like supercharging networks and Tesla insurance, were up 25%. Okay, but total revenues were down 9%, total gross profit was down 18%, and the total GAAP gross margin, measured in basis points, was down 199 BP, call it 2%. Those are not great numbers coming from a company that was promising investors a year ago that their CAGR, compounded annual growth rate, was going to be 50% year over year, with their projected demand for their auto products approaching infinity. Operating expenses up 37%, income from operations down 56%, operating margin down 6% from 11.4% only 1 year ago. Again, these numbers should have had people running for the doors, not stocking up on shares like they were discount chocolate after Easter. Net income down 55%, but only 48% if you don't stick to generally accepted accounting principles. Earnings per share diluted down 53%, but again, only 47% for the non-GAAP. Net cash provided by operating activities down 90%. Capital expenditures up 34%. Free cash flow down 674%. Yet cash equivalents, and investments were up 20%. So probably that's a hat tip to Bitcoin. This spreadsheet shows declines across the board in sales and revenues and increases in expenditures, except for the rebranded energy storage that Tesla sells. Again, hardly justification for a $20 bump in the share price by the end of after-hours trading. Page 6 takes a look at what they sold. Model 3 and Model Y produced 2% fewer cars and sold 10% fewer cars compared to the year prior. That means there was a surplus of 42,593 vehicles in that category over the past 3 months. Other models production includes all the other vehicles in the Tesla lineup, so Models S, X, and Cybertruck. And having the Cybertruck in this category makes things interesting. See, Models S and X have been on the decline, selling a smattering of vehicles quarter over quarter, but even with the Cybertruck included in this total, the production numbers have not climbed significantly, for a vehicle whose delivery event happened in November of last year. Production was only up 8%. The delivery number for that category was up 59% year over year. But if you take a look at the number compared to the previous quarter, that number had dropped almost 6,000 units quarter over quarter, allowing another 4,000 units to stack up on dealership lots. Total deliveries then were down an amalgamated 9%, and their lease accounting volume dropped 63%. Global vehicle inventory jumped 87%, from 15 days supply to 28 days worth of product left unsold. To get a better idea about Cybertruck in the future, they really should break out that abomination into its own line. There's plenty of room on this page for 2 more chart lines rather than blending 3 models altogether. Moving down the line, Tesla locations are reported at 26% increase year over year, but the quarter over quarter number shows that only 50 locations were added compared to previous reporting of 68, 61, and 79, making Q1 2024 the weakest growth quarter on the page. The Tesla mobile service fleet shows a 12% increase year over year, but it actually dropped from the previous quarter by 12 units after growing for each of the previous quarters in 2023, meaning there's a growing population of Teslas on the road, but fewer service vehicles available to assist them. Supercharger numbers for both stations and connectors show about 350 stations and 3,000 connectors accounted for in each quarter, give or take. But recent news is going to affect that growth number moving forward, and we're going to get into that later. Page 7 has one of the charts we always like to check in on, because it contains the only mention throughout the entire document of Semi and the new edition Roadster. Semi reservation holders will get some answers during the live call, after waiting 7 years for their deposits to turn into a delivery, but Roadster has been stuck in development for so long, not even the investors nor the analysts bother asking about this vehicle anymore. The next-gen platform is mentioned several times in the document and in the call, but of course, nobody outside the company really knows anything about that vehicle, and truth be told, most people inside the company likely don't either. And as we'll see during the call, asking any details about this perpetually in development platform is pointless. The excuses for declining production are listed below each factory location in the left-hand column. But while we're on the topic of things that are never mentioned in this document, you won't find the words India nor Mexico anywhere in this slide deck. So that's not going to bode real well for the bingo card. Page 8, they talk about artificial intelligence software and hardware without mentioning Dojo anywhere in this paragraph or anywhere else in the deck. They talk about the vehicle and self-driving software, mentioning the 30-day free trial of supervised FSD, without mentioning anything about the take rate from that experiment that came in at a paltry 2%. And they mention a ride-hailing functionality that the company claims to be working on, perhaps forgetting they first teased that product in 2016, then again during Autonomy Day 2019 for release in 2020, in concert with unleashing Robotaxis into the marketplace the same year. those app screenshots looking very similar to a dark mode of the slide deck image of the screenshots from 2024. So their claim of providing an experience that is best in class after working on it for 8 years will definitely need to be proven out when, or if, they ever release it. Under battery, powertrain, and warranty, the only thing mentioned is the 4680 cell, without any update as to when Tesla's arrangement with Panasonic might bear fruit for them. Under energy generation and storage, generation meaning solar panels provided through Tesla Energy, the rotting corpse of what used to be Solar City declined, with storage meaning Powerwalls and Megapacks taking credit for the 7% year-over-year revenue increase. And under services and other, while revenues were up 25% year-over-year, gross profit was down 40%, which they blamed on lower used car profits. That's probably because the average price of a used Tesla has been falling through the floor recently and steadily, and that's a large part of the reason why Hertz decided to abandon their previous agreement with Tesla. Well, that and the extremely high maintenance cost of their Tesla rental fleet, so they're flogging off their inventory at fire sale pricing of $20,000 per car. And the final item on this page praises the company's supercharger expansion, which is probably the last time they'll ever be able to write that into a quarterly, for reasons we'll cover later on. Page 10 is the last page of written description. Under volume, the company reverts to the talking point from Q4 2023 about being between two major growth waves. And as we know and covered from the 2023 call, the next wave is completely dependent upon the vehicle referred to as the Model 2, which was going to be sussed out in Texas before Giga Mexico was built, and then that plant was to produce the vehicle for export. But as reported by Reuters a few weeks prior to this call, the company is now shelving the Model 2 in favor of a different roadmap, one which investors and analysts were hoping would be clarified during this call. Under cash, they claim to have sufficient liquidity to fund their product roadmap, whatever that might be, something that will be called into question by the end of the call. Under profit, there's a typical word salad, but under product, there are some details here that might have been overlooked buried in the jargon, such as their claim that by using next-generation production methods, they expect their current lines to be able to spit out 3 million cars per year. That would be a 50% leap over 2023 numbers. Just one more thing that analysts can question during the upcoming Q&A. And their final line here mentions how their purpose-built Robotaxi will pursue a revolutionary, unboxed manufacturing strategy. That too will be tackled later in the call. Skipping over the photo frames that we'll come back to later, page 22 has several graphs. The first shows that Q1 2024 was the weakest deliveries quarter for the company in the past 6 quarters. The second shows the company dumped $2.5 billion in free cash flow, and the third shows the company with the lowest net income in the past 12 reporting periods, with the third lowest adjusted EBITDA. So obviously, based on these metrics, Tesla is a relentless 50% annual growth rate mega company that it has been made out to be by Musk, his accomplices, and his followers, except completely not. The next page, 3 more graphs, showing the pullback on total auto sales, the company's free cash flow position dropping, and the adjusted EBITDA falling to first quarter 2022 levels. Pages 25 and 26 are the spreadsheets from which the chart was given its data. It's easier to look at the chart than the spreadsheet. And the accounting on page 27 shows a lot of bracketed numbers, meaning negative numbers. This is the page where last earnings period, Tesla took a $6 billion deferred income tax payment credit, but they had no such instrument this quarter, so their net cash provided by operating activities dropped to only $242 million from previous reportings ranging from $2.5 to $4.3 billion. And as they work down the sheet, they come to a net decrease in cash, cash equivalents, and restricted cash of $4.725 billion. That number is not represented on this chart anywhere. The last line states that the company claims to be sitting on, in various forms of cash, $12.5 billion, but that compares to over $17 billion the previous quarter. That's the presentation slide deck done. So let's get into the actual call and see what everyone had to say about this. We have already released the demumbled version of the call for everyone's benefit, so for this run through we're cutting everything down to the interesting parts and removing all the chaff, starting with the disclaimer read off by Martin Vieca. Instead, we'll show you their disclaimer from page 30 that covers all the same information. freeze the video here and read it if you think you need to. Otherwise, here we go, right into Musk's opening remarks, and we'll jump in with comments after he wraps up particular points.
So to recap, in Q1 we navigated several unforeseen challenges as well as the ramp of the updated Model 3 in Fremont. As people have seen, the EV adoption rate globally is under pressure and a lot of other auto manufacturers are pulling back on EVs and pursuing plug-in hybrids instead. We believe this is not the right strategy and electric vehicles will ultimately dominate the market.
Musk is just rehashing the excuses found on the first page of the deck, and it would seem he's in a little bit of denial about Tesla's place in the market right now, especially with regards to the growing hybrid sector of the auto market. EVs, despite Musk's claim here, are presently falling out of favor, a decline that Musk has certainly had a hand in.
And energy storage deployments, the Megapack in particular, reached an all-time high in Q1, leading to record profitability for the energy business. That looks likely to continue to increase in the quarters and years ahead. It will increase. We actually know that it will. It's significantly faster than the car business, as we expected.
Again, all of the claims about the energy business are all based on energy storage, not energy generation, and the storage capacity of the devices being sold is provided to Tesla by Panasonic or CATL, or even their EV competitor BYD. So in this regard, they are repackaging and rebranding suppliers' products. How this is expected to create a sustainable energy future attributable to Tesla remains a mystery. And as we have mentioned before, in other episodes, Panasonic already has a similar product to Powerwall called the Evervolt, so Tesla is not exactly breaking new ground here. And solar plays little to no role at the company anymore. This is the operational summary from Q4 end of 2023, showing solar deployed throughout the year. That number appears right above the storage deployed stat. This is the same summary for Q1 2024, and right above the storage deployed stat is nothing. It would appear that the $3 billion corpse of Solar City might finally have been buried, as it produced no income for the company during this quarter at all. But hey, rebranded batteries, right?
We also continue to expand our AI training capacity in Q1, more than doubling our training compute sequentially.
We're going to strip down these claims a little later on, but for now, let's just say this is not as impressive as Musk is trying to make it sound.
In terms of the new product roadmap, there's been a lot of talk about our upcoming vehicle line in the past several weeks. We've updated our future vehicle lineup to accelerate the launch of new models ahead of previously mentioned start of production in the second half of 2025. So we expect it to be more like the early 2025, if not late this year. These new vehicles, including more affordable models, will use aspects of the next generation platform as well as aspects of our current platforms and will be able to be produced on the same manufacturing lines as our current vehicle lineup. So it's not contingent on any new factory or massive new production line. It'll be made on our current production lines much more efficiently. And we think this should allow us to get to over 3 million vehicles of capacity when realized to the full extent.
Take note of that number, 3 million cars per year off of the same lines, because it's going to come back into focus a little later on in the series.
Regarding FSD version 12, which is the pure AI-based self-driving, if you haven't experienced this, I strongly urge you to try it out. It's profound. The rate of improvement is rapid. We've now turned that on for all cars with the cameras and inference computer, everything from Hardware 3 on in North America. So it's been pushed out to, I think, around 1.8 million vehicles, and we're seeing about half of people use it so far, and that percentage is increasing with each passing week.
So FSD version 12 is once again profound, just as version 11 was, and 10, and every iteration going back through the archives. In fact, for the Q4 2021 call from January 25th of 2022, this is how Musk was describing FSD back then, just after the release of FSD 10.8.1.
People just do not understand how profound a change this is. It's not like some little feature. It's like the most profound software upgrade maybe in history.
It's more of the same old claims and the same old buzzwords. And you'll notice that Musk, during this segment for the 2024 call, forgot a very important qualifier in his introductory description of FSD version 12, supervised. He remembers about halfway through to start including that term. But that's extremely important to remember, especially considering Mercedes-Benz Level 3 autonomy was recently given the green light to become the first automaker to sell autonomous cars in the US that don't come with a requirement for drivers to watch the road. Their system uses a combination of LiDAR, radar, ultrasonics, cameras, and microphones to provide overlapping capabilities when taking in the driving environment. FSD only uses cameras, since as Musk droned on about during the call, he believes that we drive using only our eyes. We covered this in more detail in the Q4 2023 report, along with the fact that Mercedes has chosen the responsible route with their Drive Pilot rollout. Not only are there turquoise lights, so that other drivers, and if the case calls for it, cameras recording a crash, will be able to identify when Drive Pilot was in use. But Mercedes is also going so far as to accept liability if their system causes an accident. Meanwhile, over the weekend prior to the earnings call, a Tesla driver was arrested in Seattle charged with vehicular homicide when his Tesla ran over and killed a motorcyclist while operating on autopilot. Tesla incidents involving motorbikes are not uncommon and were enough of an issue in 2022 that the government launched a probe into those events. It would appear the findings of that probe did not result in a safer driving situation for bikers. But as Musk says, the price for Tesla's Level 2 camera-only supervised ADAS has dropped to only $99 per month, so there will be even more of these vehicles on the road for the summer. Hog riders might want to take note. Now for an update. There is another probe into Tesla's autonomous software, and this one is a Department of Justice criminal probe, investigating Tesla for securities and wire fraud based on unrealized promises made by the company about what the car's self-driving system can do compared to what the company has told people it can do. This news broke on Reuters on May 8th of 2024, which makes this announcement a little curious. That Tesla has suddenly become the largest customer of Luminar's LiDAR systems. Musk just said during this call that his vehicles are perfectly capable of operating using vision only. Yet here's this announcement, made the same day as news broke about the DOJ criminal probe. Of course, the irony of this situation is that for years, Musk has been running down not only LiDAR customers and companies, but the devices themselves, referring to them as a fool's errand where autonomous vehicles are concerned, mocking them relentlessly in favor of his theory of vision only. So if he has to reverse course on LiDAR, there's going to be a lot of crow to eat. Next up, Musk dropped some hints about what's coming up on August 8th, instead of the release of the long-awaited Model 2, upon which the second growth wave was to depend.
Since the launch of supervised full self-driving, it's become very clear that the vision-based approach with end-to-end neural networks is the right solution for scalable autonomy. And it's really how humans drive. Our entire road network is designed for biological neural nets and eyes. So naturally, cameras and digital neural nets are the solution to our current road system. As we've announced, we'll be showcasing our purpose-built Robotaxi or Cybercab in August.
In keeping with Musk naming everything like he is a 1980s Hasbro toy maker, the purpose-built livery vehicle he's suggesting he will unveil in August could be dubbed the Cybercab. At this point, people are still guessing as to what form this vehicle will take, but since the vehicle uses the same prefix as Cybertruck, maybe they're planning on using that skate to build this new ride-hailing vehicle. Maybe it might even resemble the 200 km/h minibus vehicles that Musk promised would be operating in the Vegas Loop, and he can finally retire the fleet of worn-out Tesla Model 3s at that location, which still have to be driven around by human drivers because the Tesla FSD software cannot handle driving counterclockwise around a closed one-way, one-lane loop at 25 mph. Guess we'll find out in August what form the latest vaporware will take, if the event happens at all, given recent developments. By the way, regulators in the US for the cab industry have absolutely no idea what Musk is planning to unveil either, since nobody at Tesla has talked to any of them about it at all, which lends even more credence to the vaporware suspicion towards that upcoming event.
Regarding AI compute, over the past few months, we've been actively working on expanding Tesla's core AI infrastructure. For a while there, we were training constrained in our progress. We are, at this point, no longer training constrained, and so we're making rapid progress. We've installed and commissioned, meaning they're actually working, 35,000 H100 computers, or GPUs. GPU is the wrong word, they need a new word. I always feel like a wince when I say GPU, because it's not GPU, G stands for graphics, and it doesn't do graphics. Anyway, roughly 35,000 H100s are active, and we expect that to be probably 85,000 or thereabouts by the end of this year, in training, just for training.
Musk drops what he thinks are large numbers in an attempt to portray Tesla as some sort of dominant force in the AI arena. In fact, the 35,000 H100 array that Musk mentions puts them well behind the actual leaders in the field, namely Meta and Microsoft. Google, Amazon, and Oracle also dwarfed the 35,000 number just based on the 2023 deliveries. Meta has since announced plans to pick up 350,000 H100 units compared to the 550,000 total deliveries that Nvidia manufactured last year. Musk claims to have added 20,000 of these units in the past quarter to create an array of 35,000, with eyes on having 85,000 in place by the end of the year, at which time Zuckerberg plans to have 600,000 of these units operational at Meta. The Tesla supercomputer that Musk used to brag about all the time was Dojo. Dojo gets one mention on the call, but is not mentioned at all in the presentation deck. And the thing about Dojo is that it was supposed to be built upon a proprietary chip Tesla designed called the D1 Dojo chip. But even back in 2021, major technical issues were identified within that design. Now, if Tesla had solved the D1 issues and moved into the AI forum with proprietary tech that was advanced beyond their competitors, there might be an industry edge to claim here. But since Dojo has now been reduced to using off-the-shelf tech you can literally buy now on eBay, if determining the AI leader comes down to whichever company has the most H100s wins, then Tesla is definitely trailing the pack. If you need hard numbers to consider these. Last year, Musk made a big deal in press announcements about Tesla spending over $1 billion on the Dojo project by the end of 2024. In comparison, the 600,000 H100s Zuckerberg plans on having operating at Meta by the end of the year carry a raw price tag at fair market value close to $30 billion, just for the units, never mind peripherals, labor, taxes, and whatnot. An order of magnitude larger than Musk's announcement, then multiplied again by 3. Musk is not even visible in Zuckerberg's rearview mirror right now. Now, after we put all that work into this segment, turns out these chips never made it to Tesla after all. See Musk, continuing to treat Tesla like his own personal sandbox, decided all by his onesie that Nvidia chips headed for Tesla, that Nvidia chips ordered for Tesla, should, for inconsistent reasons that do not make any sense, find themselves getting delivered to XAI or X. That, of course, is Musk reallocating assets from his publicly traded company to 2 of his privately owned going concerns.
We are making sure that we're being as efficient as possible in our training. It's not just about the number of H100s, but how efficiently they're used. In conclusion, we're super excited about our autonomy roadmap. I think it should be obvious to anyone who's driving version 12 in a Tesla that it is only a matter of time before we exceed the reliability of humans, and not much time at that. We're really headed for an electric vehicle and autonomous future. And go back to something I said several years ago, that in the future, gasoline cars that are not autonomous will be like riding a horse and using a flip boat. And that will become very obvious in hindsight.
First, when these things came out, they were the phone to have. People who owned them loved them. Most people who had them would love to have them back. By the way, where's that Tesla phone that Musk has been pumping for years now? Second, you've been using that horse line for about 5 years now, including connected to a 3-year timeline that never came true. And third, if EVs are so much better than horses, why didn't Musk just offer that flight attendant a car as a reward when he exposed himself to her on the private jet looking for a hand job? Might have saved SpaceX a $250,000 payout.
We continue to make the necessary investments that will drive growth and profits for Tesla in the future, and I wanted to thank the Tesla team for incredible execution during this period, and look forward to everything that we have planned ahead.
Next up is Vaibhav Taneja, the Chief Financial Officer at Tesla since August of 2023, when the former Master of Coin, Zach Kirkhorn, left the company suddenly, taking with him a $590 million fortune in options. And it would appear he also took with him the company's ability to beat an EPS forecast. Even with the declining forecast from $1.13 in January 2023 to less than half that, with a forecast of 50 cents for this Q1 2024 call. And they still missed that halved target by over 9%. It is perhaps unsurprising to find out that Vaibhav Taneja is an inherited asset from the Solar City acquisition, where he oversaw the final months of financial ruin at Solar City in his role as Vice President of Accounting Operations, then as Vice President Corporate Controller. Solar City never made a single dime in clear profit, and it would seem that Kirkhorn did not leave behind the Tesla company cookbook when he up and left to help Taneja out after his unexpected promotion. Here are the highlights of Tanea's opening remarks.
Thank you very much. And Vaibhav has some comments as well.
It's important to acknowledge what Elon said. We did see a season decline in revenues quarter over quarter, and those were primarily because of seasonality, uncertain macroeconomic environment, and the other reasons which Elon had mentioned earlier.
Stopping here for a minute, Vaibhav introduces a new excuse for the declining car sales: seasonality. Vaibhav says Elon mentioned this already, but that's not really true. Also, it's mentioned one single time in the presentation deck with regards to Gigafactory Shanghai only, more specifically related to the Chinese New Year, which of course happens every year, and still the delivery numbers were down year over year from Q1 2023. So despite a lower cost of goods sold due to lower raw material costs, automotive margins continue to decline. This is where having to discount the vehicles to gain a sale is biting them in the butt. Had the COGS not dropped, this margin would have been cut even further.
Auto margins declined from 18.9% to 18.5%. Excluding the impact of Cybertruck, the impact of pricing actions was largely offset by reductions in per unit cost and the recognition of revenue from Auto Park feature for certain vehicles in US that previously did not have that functionality. Our ability to reduce costs without sacrificing on quality was due to the amazing efforts of the team in executing Tesla's relentless pursuit of efficiency across the business.
And we have to stop there because if the CFO is going to mention how great the quality of Teslas are due to the amazing efforts of Tesla employees, we're obligated to remind them where the company lands on annual initial quality surveys year over year. Here's the past 3 years from JD Powers, keeping in mind that Tesla does not actually qualify for the surveys because they are not transparent with the auditors, and according to whistleblowers, the company often hides warranty issues under the guise of goodwill to throw off stats and accounting practices. But even with the information JD Powers is able to collect, in 2021, Tesla had 231 issues per 100 vehicles, placing them third from the bottom between Volkswagen and Audi. In 2022, Tesla improved their rank with only 226 problems per 100 cars, pulling them into a tie with Mitsubishi for the number 7 worst brand on the road. But in 2023, Tesla would have been dead last if not for Polestar, with 257 issues per 100 cars. Judging from these surveys, quality is not a primary concern on the Tesla assembly lines.
We've also witnessed that as other OEMs are pulling back on their investments in EV, there is increasing appetite for credits, and that means a steady stream of revenue for us.
This is familiar territory for Tanea, relying on government handouts to keep the business afloat. SolarCity found themselves doing less poorly when the government was offering tax incentives for people to install home solar, but declined quickly when those incentives dried up. Now here at Tesla, Tanea is now counting on the ability to once again sell green credits to legacy automakers whose focus is steering away from battery electric vehicles. And, gotta tell you, that whole scenario kicks our ass. See, Tesla has been benefiting from government handouts for decades now, such as the money they were given to develop battery swap technology that never came to be, and the Buffalo Gigafactory where they pay $1 a year in rent despite never hitting their economic or hiring promises. When it comes to the cars directly, governments have mandated a conversion to electric vehicle sales within the next 6 years, even though no regional power grid could hope to accommodate a 100% adoption rate. And then there's tax incentives from the government for people to buy Teslas. So you have Tesla benefiting from every possible angle, then turning around and selling green credits to legacy auto for additional profit. And still, Tesla can't make good on the 50% CAGR that Musk promised last year. It all stinks to high heaven. All comes out of the taxpayer's pocket and likely goes right into the Tesla board option packages. It doesn't go to the shareholders, that's for damn sure. Tesla has never and never plans to pay dividends on their shares. So the best advice we could give Legacy Auto with regards to the windfall the CFO is counting on is this: do not buy them. You're better off as a company and a competitor by paying the fines, rather than propping up a house of cards by buying their cheap credits.
On the demand front, we have undertaken a variety of initiatives, including lowering the price of both the purchase and subscription options for FSD, launching extremely attractive leasing specials for the Model 3 in the US for $299 a month, and offering attractive financing options in certain markets. We believe that our awareness activities paired with attractive financing will go a long way in expanding our reach and driving demand for our products.
We've already gone into the drop in price of FSD, but we're going to go back to one of the photo frames in the presentation. Page 14, where they announce Model 3s will start, keyword start, at $299 per month in the US. Then it says that equates to $160 per month after probable gas savings. And that is a dishonest business practice that Tesla has been called out for before and has started engaging in again. In 2019, they were running a similar deceptive pricing scheme on their website, and German regulators gave them a harsh warning about the practice. Finally, in February of 2023, Tesla stopped doing this, but it seems to have returned, now that the company is having a harder time making their numbers. Musk's Twitter profile was tweeting out similar information as to what appeared on the website, that Model Y was now starting at $29,490, after US federal tax credits and estimated gas savings. But there's no version of reality where you can get a Model Y for $29,490, no matter what it says on the order page for this vehicle. Bare bones, no accessories, this battery-operated disposable car, ranked second to last in IQS, is still going to run you $42,990 before fees are tacked on. Even after the federal tax credit comes back, it's still going to be $37,130, not the $29,490 being pumped by Musk. Totally deceptive pricing practice, and hopefully the FTC steps in to stop it, as Germany tried to do earlier.
Our energy business continues to make meaningful progress, with margins reaching a record of 24.6%. We expect the energy storage deployments for 2024 to grow at least 75% higher from 2023. And accordingly, this business will begin contributing significantly to our overall profitability. Note that there is a bit of lumpiness in our storage deployments due to a variety of factors that are outside of our control, so deployments may fluctuate quarter over quarter.
Former VP of Accounting for Solar City, unsurprisingly, making no mention of the fact that there were apparently no solar installations to report last quarter. Like, we checked, and they still have solar panels on the website, but no sales numbers reported at all.
On the operating expense front, we saw a sequential increase from our AI initiatives, continued investment in future projects, marketing, and other activities. We had negative free cash flow of $2.5 billion in the first quarter. The primary driver of this was an increase in inventory from a mismatch between builds and deliveries, as discussed before, and our elevated spend on Capex across various initiatives, including AI compute. We expect the inventory build to reverse in the second quarter and free cash flow to return to positive again.
These are just the numbers that we went through earlier, but Tenaya believes that the negative cash flow is going to reverse in the next quarter, as Musk is spending billions to try to catch the other AI players, while inventory of vehicles continues to stack up. Well, Tenaya might seriously regret making that statement in 3 months.
As we prepare the company for the next phase of growth, we had to make the hard but necessary decision to reduce our headcount by over 10%. The savings generated are expected to be well in excess of $1 billion on an annual run rate basis.
So here's another thing that's been hotly debated in social media, and especially on Twitter. Tesla, who say they are anticipating a second growth wave based on their next-gen platform, fired over 10% of their workforce overnight without proper notice, according to many sources. People checking their emails in the morning only to find out that yesterday was their last day at work, and the total savings to the company, according to Tenaya, would be approximately $1 billion. At the same time, the company has released a proxy document for shareholders to vote on that would reestablish the absolutely ridiculous compensation package that Musk authored for himself that was rightfully reversed by the Delaware Court of Chancery. That compensation package, if reinstated, would allow Musk to again siphon $56 billion of value out of the company in the form of options, which is a greater amount than all the profit ever realized by the company across all divisions since the day the company was founded by two people that were far smarter than Musk. Only 2% of the compensation package that Musk is demanding back represents the savings the company realized by putting over 10% of their workforce out on the street. And it's likely we are not the only people who find that situation to be unconscionable and despicable. Also, good luck executing your next growth wave without 14,000 members of your global workforce. This was not done to prepare the next wave. This is blood in the water with more to come because there are more rounds of firings coming down the pipe. Even while we were wrapping up the script, more entire departments got scrubbed, creating other repercussions that we're going to cover shortly.
In conclusion, the future is extremely bright, and the journey to get there while challenging will be extremely rewarding.
Now, just to clarify, for the people who have been fired from Tesla during the past 2 months of layoffs and counting, when Taneo was talking about the extremely bright and rewarding future of Tesla, he was not talking to you. When we come back in part 2, we'll be diving into the questions that investors filed in advance on this call to see the most pressing concerns they had about the company's performance and their near-term future.